All right, cool. All right, let's get started. Quick updates before we jump into the monthly report. Let's talk about the migration. Everybody's keyed in on that. They want to make sure they do it right. They want to make sure they don't miss anything. So let's talk about that first. I had a call with the developers yesterday. We are pretty solid set into our end of March timeline. So next week, we will have all the contracts on testnet so we can go through and make sure everything's running properly. I don't suspect there'll be any issues because we are just refactoring our existing contracts. So we're going through and making the necessary changes to the mechanics, the name, that sort of stuff. But about 80% of our mechanics are going to remain the same. It's just a matter of changing some of the destinations and percentages and making sure that we automate a couple of the things that I've been doing manually. So migration wise, we are still in the same timeline. So the way we're going to do it is from essentially March 15th through the end of the month, we will remove the withdrawal tax on the farm. You don't have to get out immediately. So the reason we're doing a 2-week window is in case people have schedules where they can't do it on the last couple days. So if for some reason you're traveling or some reason you don't have access to your funds for that week, 10 days before the end of March, you can do it early and not risk experiencing any fees on withdrawing your farm. But if you want to take advantage of rewards up until the day or two before we migrate, you're more than welcome to stay into the farm until the last minute if you're hands-on with your portfolio like that. That is up to you. It's your prerogative. But we wanted to give a 2-week window so everybody had a chance to make sure that they pulled their farms, to pull their liquidity without experiencing any fees. So that is going to happen essentially March 15th, 16th through the end of the month, 31st. We will migrate the 1st of April, roughly, give or take a day. And then we will have a 2-week window on the other side for you to be able to deposit into your farms without any fee as well. So that process for farmers, you'll be able to do it. It is manual. You'll have to do it if you are farming, but you will be able to do it without any fees. So it's important that we do it that way. If you're staking or if you're just holding tokens, you don't have to do anything. Just leave it. Just leave them where they are. On the other side, we will not airdrop because somebody objected about us airdropping because of taxes. So we will batch deposit tokens into both staking and just standard tokens into your wallets based on the balances of the old protocol. Because it's a one-to-one migration, there's no math that we need to do. It's literally just 1-for-1 token of the new token into either staking or into your wallet. So it's going to be very simple. It's going to be automated for everybody except for farmers. So if you are farming, you do have to do that process within that 2 weeks and then the 2 weeks after. But everything is good. So front end is being completed. So they're working off the Figma now to build out the front end. Again, they're just refactoring the existing DApp. So it'll look almost identical. Slight change in some of the colors, slight change in the text, logo's different, but you will recognize the DApp immediately. You will know exactly how to use it. There's just some variations. There's only one farm instead of two. There's a little less on the trade page than before. A couple of the assets are different on the trade page from before. But overall, it should be a smooth transition, both functionally and your working knowledge of the protocol. So that's all good to go. That's on time. That's on schedule. No delays there that we can see or anticipate. So that's all good for the migration. When it comes to the client services, so Barry and I had a call this morning. We are deep into our conversations with potential clients, but we're also, we have an opportunity to make our organization even more official in the country of Panama, which I can't dive into the details right now, but we have an opportunity to greatly expand the amount of capital we can manage by going this additional route. So as a business, everything's already formal. We have our legal opinion, our legal counsel, we have our terms and conditions. Everything's in place to operate a business within the country of Panama. We have a drafted compliance manual in case Panama ever decides to specifically regulate cryptocurrency. At this time, it doesn't appear that they will be doing that in the near future, but at some point we anticipate it will happen. However, there's a couple more steps we can take within the country and within our network within the country that will allow us access to significantly more capital that we can manage, and we can do it in an official way. And so we are currently in those conversations. We are very excited about the potential of those conversations. So it is the next evolution of this process of being able to bring in client funds, collect a client fee off of them, and then bring them back to the organization. It is something that even today, when Barry and I got off the phone, we kind of had a moment where we're like, this has legs. And because it's capital coming from TradFi, anything above 30% is something that is going to attract significant sums of money. And if we can become the premier option for a lot of those wealth managers like we anticipated, it is something that gives us legs and growth opportunity within the organization. And again, all of you and the protocol fall within the organization. So it is a very exciting opportunity and potential for us. So we're continuing those conversations. Naturally, they don't go as fast as DeFi and crypto, but the scaling opportunity is something that we cannot pass up. We have to explore it to its fullest extent, and that's what we're doing. But it's all good news. Again, these are all things that, if there are any changes to be made, they're changes that allow us to expand and grow. And as we move into the next year, ETFs obviously changed everything, right? We kind of mentioned that before. Anybody making predictions now, they're insane. I stopped making predictions. I said it to a couple people last week. I was like, I made my prediction a year before the ETFs really kicked off. We have new data. We have a new paradigm. We are in uncharted territory. We've never had an all-time high before having. No one knows what's going to happen now. All you can really do, follow the liquidity, follow the inflows, follow the outflows, anticipate what you think might happen. It is something that we are looking at, obviously, the next step in that ETF process, which is Ethereum. We anticipate an Ethereum ETF at some point in the next 3 to 6 months. Obviously, if you look at what's happening to Bitcoin, an Ethereum ETF would obviously do significant amount of damage to the price of Ethereum. Yes, Ian, I wrote an article. I didn't even want to bring it up, but you had to bring it up. Okay, I wrote an article. I wrote it March of last year. All of my data, all of my opinions were based off of more than a decade's worth of information. Okay, and I will openly admit, because I don't have an ego about it, that because of the ETFs and this dynamic shift in the market, everything I said is mostly wrong. And I'm okay with that because we were wrong in the right direction, right? Like, the price is up. There's a significant amount of money in the market. I think a lot of that institutional inflows will bring stability to the market. And it is something that now we get to see what happens to those inflows when an Ethereum ETF comes in. It'll fracture the inflows, right? Not as much money will flow into Bitcoin, although it'll continue. It'll start to flow into Ethereum. And then after Ethereum ETFs, you assume there's going to be some sort of basket ETF of like anywhere from 3 to 10 assets within the space. So what you're going to have happen, at least my anticipation would be, that you're going to start having larger players try to front run and anticipate what those assets are. So like, all right, you have Bitcoin. Now Ethereum's probably going to run pretty high into the market into the summer. If you look at the Ethereum Bitcoin chart, Ethereum's price against Bitcoin, it's still 50% below its all-time high, or its high from the last bull market. And so Ethereum is underpriced against Bitcoin currently. But then you're going to have people speculating like, is Polygon or Matic next? Is Litecoin? Like there's going to be a number of assets within the top 20, top 50 that will be vying to be included in a basket ETF, which again, I anticipate will have an impact on the capital inflows for the market. So it'll be a very interesting next 2 years of seeing what happens with the market as institutions flow in both into Bitcoin, Ethereum, and other blue chip altcoins. I think that's it for non-monthly report updates. Anybody have any questions before we jump into the PDF? Call said, right place, right time. Panama is hurting. They closed their mine, generating 5% of GDP, and the canal is drying up. Investors there will be casting a wider net. That actually is true. That was mentioned offhand by one of our contacts that there is an urgency among particular investors to widen, diversify their portfolio. And so there is a perfect storm of opportunity for us to carve out a small niche within the country. Like we still very much dream big, but we also want to make sure that we are, being realistic about what we're building. And there's also like the conversation of scale. We theorize like a portfolio somewhere between 20 and 30,000 would be like our Goldilocks zone. If we got bigger than that, we might have issues scaling with our strategy and have to either adjust our forecasting or dig deeper into other potential opportunities for yield. A little bit smaller, you leave money on the table. So we have like just a theorized Goldilocks zone of what the portfolio could look like from a dollar standpoint. We could be wrong. It could go higher than that, and it doesn't have any major impact on yield. We don't know. It's just something that we have hypotheses. I say it all the time. Everything's a hypothesis. You test it. If it works, great. If it doesn't, you stop it and you adjust. So that's something that continues to be one of our core principles when it comes to the organization and the protocol. What resources do you use to view inflows, outflows? I don't have any particular one. To be honest, I usually peruse Discord, Telegram, Twitter, and a couple other places that just talk about inflows, outflows. I'm sure Carl or Michael will have I'm sure there's a website that people are pulling all of that core data from, which I'm sure I just don't have the resource on the top of my head. Usually other people are giving it to me. It's probably the lazy way to collect information, but it's convenient. So if anybody does have like the actual sources of data when it comes to ETF inflows, outflows, feel free to drop it in the chat so people can look at it. It's always good to go to the source. Fortunately, I don't always have time for that. So when somebody tells me, like Michael will tell me like, hey, this is how much we saw coming in this week into ETFs. This is what was reported. You never always know if the report is completely accurate, but at least gives you an idea of what it looks like. Perfect. Paintball's got you right there. Paintball is the HODL 15 Capital. Is that like they update every day, every week? They'll keep feeding you information. Daily inflows every day. Cool. Awesome. I knew as a community we would figure it out, so I appreciate it. Call said, tricky with ETFs beyond Ethereum. Only Bitcoin and ETH are not securities in the eyes of the SEC. That is true right now. However, Wall Street has a way of influencing the opinions of three-letter organizations. So I would not be surprised if the SEC softened or pivoted a little bit on more than just Bitcoin and Ethereum at some point in the next 18 months, where ETFs outside of those two assets would be welcomed and monetized by everybody with money. So, all right. Are we ready to get started? Let's get started. We're going to, from your mouth to Gensler's ears. Yeah, I agree with you. We're going to get started. We'll go through this real quick. The month of February was good for us despite the fact that there was only 29 days in the month. Usually there's only 28. So we got lucky because it's a leap year. Let me pull this up, do some screen sharing. I'm by myself. So if somebody asks a question and I don't see it until later, I apologize. We can blame Michael for not being here. In fact, I encourage everybody to blame Michael for anything that goes wrong, because he's not here. Share my screen. No, I don't want to share the longhouse. You guys are in the longhouse. You can see it. Google Drive. There we go. I don't need a high frame rate because it is a JPEG. No, it's not JPEG. It's PDF. All right, cool. All right, can everybody see my screen? Michael is not sleeping. Michael is filming a TV show in the desert. He's one of those very special people who gets to sit behind a camera. They say action for like 30 seconds. They spend an hour and a half resetting the shot. And then they say action for 30 seconds. They spend 2.5 hours setting up the new shot. They do 3 takes for 5 minutes. And then they break for 3 hours while they move locations. That is filmmaking. And so if anybody has ever been on a film set, Michael and I have been. I know a few other community members have been. It actually is incredibly time consuming. And when it's actually the acting and the actual filmmaking is taking place, is a very, very small fraction of time versus all the time you spend sitting there and waiting. Filmmaking is a lot of waiting. All right, let's get started. February 2024, end of month report. As you can see in the bottom left corner, there's a new logo. That is our BlockCentral logo. If you look at my Discord profile, you'll see that as my cover photo. So next month, we will be transitioning the brand over completely. So this will be one of the last times you see the Stasis Network name. So, a little nostalgia. Graduation goggles. Enjoy it. Contents, you guys already seen the contents. That's all good. February summary. Monthly report. You guys know all this. We kind of keep it the same every month. Protocol health, performance metrics. So for the month of February, our return was 6.2%. So that is 5 months in a row of at least 6% return for the DeFi Fund, which is fantastic. We're looking at a situation where we just now have significant volume coming back into blue chip DeFi towards the end of last month and into this month. We are in a position now where we are starting to manipulate our allocations to improve our returns. And so here in the middle of the screen, for the month of February, we implemented a new strategy of dynamically adapting position sizes. So for the last half of January and through February, for example, we have Pendle. Pendle had a fantastic run over the last 3 months, and its trading volume was off the charts. And we had an opportunity to expand that allocation to soak up yield. And so what we do dynamically is we'll shift capital from one CLP to another depending on how it's performing. Now we do this obviously responsibly. We don't want to put $200,000 into one position and it be like roll bit, and it might print 300% APR, but it's also roll bit. So there is a significant amount of consideration for the process of choosing when and how we do that. But for example, Pendle, it was 60,000 and we shifted it up to 90,000. And Pendle was like the bulwark of our yield for the month of February. And so the total yield for the month of February was actually $38,520. About 6.2% of yield against the fund. So notes of interest, trading allocation returned 4% for the month. We are going to be reducing the trading allocation. It was a good experiment. We have different allocations spread around. We wanted to experiment with some things, and unfortunately, we're to the point now where we feel like we will be earning more and have better returns if we scale back the allocation. So we had a hypothesis about what we were doing with it. The results were what they were, so we're gonna return most of that trading allocation back to the fund, integrated into our yield strategies, and kind of go from there. We shifted our wrapped Bitcoin, wrapped ETH to Optimism from mainnet to improve ease of management and increase the yield potential. So mainnet, all things being equal, so if you had the same range, mainnet was about 35%, where Optimism was 42%. On top of that, if we do need to rebalancing on Optimism costs about 25 cents versus rebalancing on mainnet, especially with the gas fees we see now, is about $150. So every time we would need to rebalance on mainnet, it's anywhere from $100 to $150 with today's gas prices, where if we were to do that with higher yield on Optimism, it costs us less than $1. So we want to make sure that we're acting as cost effectively as possible. And then we exited the GMX CLP position due to poor yield performance and more market competition. So GMX was a leader in decentralized perps dexes for quite a while. But we are to the point now where there's so much market competition with dexes and perp dexes within crypto, and GMX isn't doing anything from a trading volume standpoint that warrants us continuing to operate in it. Now, again, we always keep an eye on it. If that were to change, if they were to innovate to the point where they start to pull in significant amounts of TVL and liquidity starts to flow back in that direction, we might revisit it. But as of right now, we saw better earning opportunities elsewhere. So we did exit that CLP position. Again, for February, generate 38,500. That's 3,000 more than January and December, despite we had one less day. Actually, we had 2 less days for February than we did December and January. And then we talked about client services. So we continue to progress with the structure and framework. So, okay, one other thing I want to talk about while we're on this page. So we talk about token price, market cap, tokens burned. So a little nostalgia. Back in late September, early October, price was pretty low, right? Like we were 0.65 of a cent, 0.7 of a cent. At that time, we were fully collateralized against the DeFi fund. We made a big deal about that. We talked about it. Like this is good. This is healthy that we are fully collateralized against the DeFi fund. Now, at about 1.05 cents, we are fully collateralized against the DeFi fund. So 4 months later, at 0.0105 versus 0.007, we are fully collateralized against the DeFi fund. That is a significant jump, and it's important that people understand what that means. So we undervalued, yes, but the key is there's a curve there. There is a value curve there. Every time we burn tokens, that decreases the amount of liabilities within the fund. And as the DeFi fund grows, the backing value increases. So from October to February, we basically increased the backing value of the token by about 35%. Now, the goal with client services is to obviously burn as many tokens as possible, increase the size of the DeFi fund as large as possible. And through that, the value of the token will continue to climb. The backing value of the token will continue to climb. So my hope is by the summer, the backing value of the token is 1.5 cents. And then by the fall, it's 2 cents. And then we hit an exponential growth cycle where we're increasing the value significantly. But it is something I do want to point out. October, 0.7 cents was the threshold of being fully collateralized. Now, above 1 penny is the threshold for being fully collateralized. Now, did the price climb above that and then back down? Yeah. We have people that sell, people speculate on the value, people move on to other opportunities. That is just the nature of this space, is opportunity cost. Some people see opportunities to earn elsewhere. We appreciate them being a part of the community, even if they sell. If you guys sell, you don't have to leave. I say that all the time. I said that at the very beginning, is if somebody were to sell, they don't have to leave the community. That's like a weird DeFi thing that for some reason, apparently people need to think you need to be a holder to be here. That's not the case. So, but it is something that I do want to point out is there is a backing value growth curve there that isn't always clear to people, but it is happening. And so over time, that curve and that value will continue to increase. So it's important that you guys are aware of that. So I wanted to make you aware of it. Moving on, yield generation. So this is the 5th month of our quote new strategy. It's not a new strategy anymore because we're 5 months into it, and the results continue to be impressive for us. Again, another month above 6%, 38,500 in total revenue in January. February. Ian asked me if I proofread the slides, and I said yes, of course. But as I'm presenting it, I see that this says January instead of February. My bad. Ian, that's my fault. I should have caught that. So 38,500 for February. Total revenue. Since inception, we have now officially earned over $200,000 in yield. And if I remember correctly, we have spent almost $150,000 on buybacks. So over $200,000 in yield, almost $150,000 in buybacks and burns, and the DeFi fund has increased in value every month since October. So green. So all 3 of those are green, which is great. Fund diversification, again, nice, pretty slide for you guys to know that we are diversified. That's something that continues to be a focus of ours. 20, 25 positions, depending on if you're counting like our Eigen layer allocations. One thing that is interesting now is if you were to look at the DeFi fund on DBank, we're starting to get our Merkle like allocations distributed a little bit. Like I noticed it about 2 weeks ago, we had like $25 in there. And now as of today, I think it's like $350. And so I'm under the presumption that it'll continue to climb at least for a little while. I need to check with Michael about the actual dynamics of that, but it is starting to produce a bit more yield for us. Glad I bought those NFTs. So NFTs, again, we're automating that process, right? So right now, 10% of what we burn goes into the NFT contract. In the new mechanics, 10% of what we have allocated to burn, which is 5% of the total fees, will go to the NFT contract. So that'll be automated. So it's not just a static number of tokens backing each NFT. And when it runs out, it runs out. It's always being replenished on a percentage basis from the fees and the mechanics of the protocol. So it is a long-term lucrative way to earn rewards by holding one of our NFTs. And remember, the NFTs will be identical. Artwork will be identical. Clans, attributes. The numbers will be scrunched down. So it'll be a collection of 240 NFTs, and it'll be 1 through 240 instead of a mishmash of numbers up to 700. So because we redeemed all of those NFTs, we're going to start fresh with 1 through 240. Moving on. Token dynamics. Again, we talk about this pretty frequently. Circulating supply, 58.5 million circulating supply, 14.7 in the NFT contract. We don't own any, at least at the end of the month, we didn't own any. And then we burned 186 million. So the nice thing about migrating to the new protocol and the new mechanics is this number will start over, and we can watch it grow from zero in a natural way. While this is fun to see this number, this 186, it is silly because we started at like 170. Like we burned a significant most of the tokens right off the bat. So it'll be nice to see this start back near zero, and we can watch it grow organically. But always between the operational balances and the DeFi fund, this operational balance, I'll explain it in a second. But this number almost always adds up to right around 80%, 81%, because we try to keep as much in the DeFi fund as possible. This month is a little different. This month is unique, and I'll explain that in a minute. But other than that, everything is allocated towards the health and growth of the protocol. Yeah, Ian does a great job with the graphics. Like Ian's are like secret weapon. Like if we need data to be displayed in a certain way, I'm like, Ian, this is kind of what I'm thinking, and then he'll make it, and I'm like, well, that was not what I was thinking, but it looks fantastic, so we'll just use that. So he has a way of taking my very broad generic ideas and then turning them into stuff like this, and I'm like, cool, that's exactly what I wanted. And then I walk away going, that's not what I wanted at all, but it's way better. All right, moving on. The numbers. DeFi Fund monthly performance, February 2024. So going through these, 1 through 5, a lot of CLPs. Those are all on Arbitrum. Foxify here is on Arbitrum. I will point out Foxify almost doubled in value for us in the month of February. Danny and the team are making significant progress on their V2 of their perps. Seems to be a lot of interest in what's upcoming, and that has been displayed on the market. So we're happy to see value increase there. Helps with our numbers, and obviously as an investment, it's much healthier. Like I said, trading allocation earned about 4%. We will be pulling that back. Next month's number will most likely be 25,000, so it'll be significantly reduced. There's a line on here called client miscellaneous. So there's about $67,000 accounted here. I know a couple community members have messaged me asking about the overall balance of the DeFi fund. We are in the process of doing significant things across the board when it comes to yield generation, client services, structure, all of the paperwork. There's a lot of OTC services. There's a lot of things that we're doing that result in us needing capital temporarily. This will not be here for the March update. So this is something this is a one-off, and it will be reintegrated into the DeFi fund this next month. I can point out, if we go through the rest of this is all of our CLPs, Eigen Layer, Pendle. One thing I will point out is Pendle, where is it? Number 3. So Pendle was by far our largest CLP. It earned $9,300 in yield just for the month of February. And like I said, it was the total workhorse of the organization. And Brent, he brought up our strip club funds. If you find a strip club in Panama, you let me know. We might have to bring some clients there. You got to close the deal. Whether you're closing it on the golf course or at the club, ABC, always be closing. That's what Glenn Ross taught me. But anyways, Pendle's CLP was the stalwart of the month, and this month actually, it's Pendle and Optimism. So our wrapped ETH op on Optimism is just printing money for us. But that's the beauty of us being diversified. And actually, for the month of March, I don't want to get anybody's hopes up, but for the month of March, through 7 days, we were on pace for 55,000 in revenue. Not 38, which we had this past month, which is great. We're on pace for 55. Now, I do anticipate volumes probably will drop off throughout the month. It'll average out. But through the first 7 days of the month of March, we are significantly ahead of schedule when it comes to projected revenue, which is huge for us because we've been doing a good job of managing our CLPs. I know Call reached out to me and asked about the ranges. They were getting a little tight. They were getting a little wonky, and I agreed with him. We went through and we balanced them out a little bit. We gave them a little bit more breathing room, and we have seen a positive impact with that, plus the trading volume, resulting in we're on pace for a 50,000 plus month for the month of March if volumes continue, and that would be fantastic for us, especially as we go through and we have these conversations with clients. Strong months improve the strength of our pitch. You know what I mean? So that is something that we're in the process of monitoring through the month of March. How do I feel about the huge ARB unlock happening shortly? I am cautious about it. I still need to talk to Michael about what we're gonna do. We have discussed it twice now about if we are going to scale down our wrapped ETH ARB CLP just a little bit, just to reduce exposure a little, because unlocks historically were always seen as like a bearish thing, but there have been examples over the last year where an unlock will happen and the price won't move at all. And so we're in a position where like we want to be prepared for it, but we also don't want to overreact and miss out on volume, So it might be something where we rebalance the position into a short bias with a wide range. And yeah, unlocks, they're normally bullish, right? So like, but you do have, I guess maybe I'm speaking from like a crypto Twitter sentiment, the irrationality. People see an unlock as like you're going to flood the market with liquidity, more supply without any new demand. Naturally, the value would drop. But again, it will double circulating market cap, like you said. So there is, I think, Michael and I's conversation, because we're always kind of strategizing. If we don't scale the position down by much, we may sacrifice a little bit of yield by widening the range, maybe giving it a bit of short bias and seeing what happens. Yeah, we still have 13 days. Yeah, you're right. And so that's kind of, we're watching it, but again, we don't want to overreact, So there is times where you can do too much. You can micromanage to the point of actually sabotaging some of your potential. So it's a delicate balance. We're trying not to make a mountain out of a molehill, but we're trying to make sure it stays a molehill. At the bottom here, most important part of this is This was, so we started, hold on. Yep. So we started the month at 538,000. We ended the month at 615,000. And so 38 and a half came from yield. Another 38 and a half came from appreciation. $77,000 growth in value over the month. So it was a very strong month from us from a value standpoint, as well as yield. But I have a feeling if all things continue to work in the right direction for the price of the blue chip assets and just the market in general, and if the volume stays high, I think we'll have another really strong month for the fund overall. DeFi fund allocations, just another visual for you percentage-wise. Trading allocation at the top and down. Again, these will be adjusted next month as we scale out of the trading allocation. We integrate that capital back into the different strategies and then prep for client side. So a big reason for reallocating the trading side is so far we haven't, as much as we've made the most of the strategy as it exists, we want to see how we can perform for a couple months with a vast majority of the capital committed to the core strategy and see what the results are. So we want to test that data, especially with the bullish sentiment in the market at the moment. DeFi fund and operational assets. This again fluctuates from month to month depending on what we have in the accounts that aren't in actual positions. So this month just happened to have about $5,700 more in operational assets versus the month before. It's neither a positive or negative when it comes to the health of the fund. It's just a matter of accounting for it in the overall report. DeFi fund metrics are always the one that I care about more. Total beginning of the month USD value was 542,000. End of the month 625. So that is a full $83,000 increase in DeFi fund value over the month, including our yield. So about 16%. And we like it. We like that a lot. Hold on, let me check questions. Any questions? DeFi Llama has it listed as March 22nd. I'm assuming that's for the unlock, right? That you're talking about, the Arbitrum unlock? That's my assumption. But you know what happens when you assume. Treasury allocations. This is our total value from the start of the month to the end of the month. From DeFi Fund, all of our operational balances and our farms and LPs. This one is one that makes me very happy. We started at 662,000. We ended at almost 800,000. So that is a very happy peasant for the month of February. And I hope to see that continue for several months into the future. That is significant for us. But that is that fully collateralized narrative that we're talking about. So right now, we're close to fully collateralized. It's a little lower. It's like 1.1 cents is fully collateralized, where in October it was 0.7 cents was fully collateralized. That's a significant jump in value for being fully collateralized, fully like the backing value being fully intact in a very short amount of time. And we're going to continue to push that number as we burn tokens and grow the fund. Operational and LP allocations. This is just another metric. It's neither positive or negative. It just means that our LPs remain healthy. They went up almost 50,000. Value of Matic going up. Value of Stasis going up. Value of STS Plus even going up. There's been a lot of arbitraging that's been needed on the two LPs, which thankfully is another thing we're going to get rid of when we move to the new protocol. But that arbitrage, because of the taxes in and out of STS Plus, caused it to go up in value. So all three of those assets together going up in value have resulted in our operational LPs and seed farms to increase in value by about 50,000. All right. Protocol metrics. Last page on the report. The fully diluted value market capitalization. So let's go this side first. That dropped by 70,000. The price didn't move much. But of course, when it comes to market cap, it's hard to measure the health of a protocol that is deflationary like ours based on market cap alone. Our FDV market cap drops like that, not just because of price, but because we are constantly burning tokens. When we move to the new protocol, I suspect that our fully diluted value will either be flat or decrease as we burn supply. Now, don't get me wrong. We find ourselves in a position where we got a couple silver bullets when it comes to our revenue. We start really pumping client fees. So, like, what we want to do with client fees is a portion goes to buybacks and burns, a portion goes into the DeFi fund, which increases its value. Back in value increases, value of the token increases, the fully diluted value will increase. It won't increase as much as a static token supply-wise would because we are deflationary. But market cap isn't the best way to measure the health of a protocol like ours because we are constantly burning tokens. Most important thing that I always point out is the LP to treasury ratio and the LP to market cap ratio. So the one that matters the most is circulating. So 9 and 10 here. LP to circulating market cap, backing LP to circulating market cap. So LP is total, backing LP is the blue chip side of the 50-50 LP is the blue chip side. So whether it's Matic or STS Plus, which is just wrapped USDC, that ratio has always been right around 40%, 20%. Extremely healthy. We have more than enough liquidity for users to move in and out of the protocol without too much slippage when it comes to the value of the token. Pretty good, huh? All right. Token supply and burns. Token supply dropped by 1.3 million, 1.2 million. Circulating supply dropped by about 700,000. So remember, tokens are released from the NFT contract. Tokens are bought back on the market and then sent to the rewards contract. So there always is going to be a discrepancy between total supply and circulating supply because tokens are being released into circulation. We are burning tokens, removing tokens from circulation. It's always a net negative, but it's not going to be the total burn. That's not going to be a correlated number. So tokens remaining in NFT contract, 14.7. Total burn for the month, 1.2 million. Total burn historically, again, we talked about that before. So we burned 1.23% of the circulating supply during the month of March or during the month of February, which is great. Market OTC token buys and burns, a total of, we did about $25,000 in buybacks for the month of February. We try to keep it about $1,000 a day, give or take, between OTCs and the market purchases. We just have this constant flow of revenue. It's revenue. It's not like we're taking principal, reducing our earning potential from that principal to go back and buy tokens. So we're not sabotaging the principal to buy back tokens and burn them. We're using revenue. And unless the principal disappears, that revenue is perpetual and we are a deflationary protocol. So holders have a finite number of tokens. In theory, we have an unlimited amount of revenue. Eventually, it's a game of attrition and the house will win. It might take longer, and it's a fast moving market. So I understand sometimes people get impatient, but it is a game of attrition that eventually the protocol will win. And so the length of holding the tokens, earning the rewards, will pay out in the end. Also, keep in mind, we did talk about in the new protocol, we are going to intentionally avoid putting too much protocol-owned funds into the farm. And with the staking rewards being double and the farm rewards increasing as well, My hope is that the farm APYs will be at least 50 to 100% higher than they currently are now. And that's a way for us to reward holders. My goal is to never do a manual burn. With the way the mechanics are structured, about 50% gets burned, right? So if I want to burn tokens, I have to go through the reward contract, which means stakers get more rewards, farmers get more rewards, and we burn tokens. So if I want to burn a significant amount of tokens, I'm just going to have to reward you guys more in the process. So that's my goal is if we use the mechanics exclusively of the new protocol, rewards will be higher, marketably higher in the new protocol. So I'm really excited about that. And that's the end of it. You guys like the new logo? It doesn't look like a C and a 3. Someone said Boston College, which is a total American thing. Questicle, debating on staying in the farm after the update or just going full stasis. It's going to be an interesting question. Staking rewards are double, but the supply is the same. Now, I'm guessing some of the farm tokens between the two farms will go into staking. So it might not be completely double. But also, farm rewards are a little lower because we have protocol. We have protocol supply in the farms, which we are going to intentionally leave out most of it in the new farm. So, bit of game theory there about how you want to operate. Obviously, Ethereum's not going to move as much as we hope Block will move over the next year and a half or so. So you do have to worry about a little bit of impermanent loss. But my hope is that the rewards are that much higher that people are more than willing to provide liquidity for the protocol. Now, it doesn't mean we won't have less liquidity. So I know I got in a conversation with somebody the other day. It was about 2 weeks ago. Us not having liquidity in the farms doesn't mean we don't have liquidity. So the protocol will have the LP tokens. They will be created. They will be providing liquidity to QuickSwap, where the underlying liquidity exists. That's the pairing that you see on Deck Screener. We just won't deposit the LP tokens into the farm. So as a protocol, we'll still be providing all the liquidity that the protocol needs to be healthy. We just won't be depositing the LP tokens into the farm, which then benefit from the protocol rewards. It'll only benefit from QuickSwap LP providing rewards. So it's important to remember the difference. So it doesn't mean that the protocol will depend more on you, the user, providing liquidity. It just means if you do provide liquidity and deposit it in the farm, you'll get more rewards. NFT contract will continue to get deposits from burns. So Fluffy, we are automating that. So the new mechanics, staking rewards are higher, farming rewards are higher. There are no protocol tokens anymore. So the protocol does not gain anything from the mechanics anymore. We don't need it. We are over that now. That is a antiquated part of the mechanics that no longer serve the protocol. So what we can do is we can take that 50%, 45% of it will get destroyed permanently, and then 5% automatically gets deposited in NFT contract. So instead of me depositing into the NFT contract manually whenever I do a manual burn, basically every day the NFT contract will get some tokens. So that way, it's just a straight automated replenishment of the tokens. Plus, there's also the consideration that it's percentage based. So the decay rate of the NFT contract is percentage based. So I think right now it's 0.9%, 0.85. Some we adjust it over time based on the health and value of the token, but it is percentage based. So theoretically, the contract will never run out of tokens. The idea is because it's percentage based, over time it gives less tokens, but over time we expect the token to be more valuable. So the anticipation is that there is a relatively flat weekly distribution of value of the NFT contract, despite the number of tokens slowly decreasing over time. That's the decay part of the contract. But because it's percentage based, the number you're getting this week divided by the number of tokens in the contract is not accurate, because the number changes every week because it's based on percentages. Plus, we will also have the weekly, or not the weekly, the automated, basically daily drips from the mechanics into the token count as well. Yeah, so Questical, when it comes to that, like, we'll have the LP tokens. We will provide significant amount of liquidity to the protocol on our side. We'll just have less of it in the farms, which means there'll be more rewards available for those users who are farming. So it is something that we monitor, but moving forward, we would like to reward you guys more for participating in the protocol, mostly because there's an opportunity cost for a protocol like ours, especially in a bull market. Everywhere you look, somebody's hitting lottery ticket on a meme coin for like 1,000x. It's nice to be reminded they are lottery tickets. 99% chance you're going to lose money, but in a bull market, you hear it more, you see it more, psychologically you feel it more, and it results in you feeling like you're missing out. Now, we know that we can go two ways when it comes to our protocol. We can focus on increasing the value of the token, but it will decrease the amount of rewards. Or we can focus on increasing the amount of rewards, but keeping the value of the token, and the value of the token ends up being a little flatter. At the end of the day, with what we're building client side, we have an opportunity to both increase the value of the token, but still focus on delivering rewards to you guys. So we know, going into a bull market, the psychological opportunity costs of holding a tortoise like ours, I openly call it a tortoise, because you're not going to see 50%, 60%, 100% in a week on our token. It's just not going to happen. It was never designed that way. And we've been pretty upfront about that from the beginning. However, we can ensure that the value you're receiving from it is elevated because it is a bull market. So by allowing the farms and stakers to earn more rewards relative to the performance of the protocol in the future, it at least helps fill that gap a little bit of you guys feeling like you're missing out. It also goes back to the feeling of being overinvested, which is why from day one we told people, like, 10, 20% of your portfolio you can put here, treat it like a crypto mutual fund, but everything else, like, use the rest of that money to prep for the bull market. We said that since May 15th of last year when we launched. And so that's the process of how do we reward more without feeling like we're undermining the mechanics of the protocol. And that's how we're going to do that. So we're going to do it in a managed way, but rewards will be noticeably elevated in a way that's both sustainable, but you guys feel like you're earning your piece of the pie, shall I say, when it comes to the bull market. All right, let me look at FIP's new memes. Are these new memes or old ones? I thought you were going to start making BlockCentral memes. What's the deal? Do we have a date yet for the not airdrop? Not mid-April. I would say beginning of April, screw up Texas. So we will have that window of time where the farms are tax-free withdrawal. So basically March 15th, 16th to the end of the month. We plan on migrating the beginning of April, and then there will be that 2-week window of you being able to put into the farm tax-free through mid-April. But we anticipate we will be fully migrated liquidity token live the 1st of April, within a day or two of that timeline. That's when we anticipate to be fully migrated. Cool. All right, we are past an hour. I spent a lot of time talking. If anybody doesn't have any pressing questions or curiosities or want to know what the weather's like here on the West Coast, I think we should probably wrap this up. Questicle, no. So as a staker, you don't have to do anything. So what will happen is for stakers and people just holding tokens, you don't have to do anything. Just let it sit there. And when we prep for the migration, we will basically the specific terminology is deposit on behalf of you. So we will deposit your tokens into the staking contract on behalf of you. What if you want to stake more before migration? If I break farm and go full STS, I will talk to the team. I did hypothesize to the team that we can allow people to commit to staking. You know what? I'll probably just do that. You have changed my heart, Equestical, in this moment. I will remove the deposit tax on staking for that 2 weeks as well. So if you would like to commit your tokens to staking the 2 weeks before we migrate, I will drop that tax. So you can put your tokens into the staking contract for free. The withdrawal tax will remain in place, so people can't be like, "Oh, I jumped in for 2 weeks, got staking rewards, and then withdrew." So I will keep the withdrawal tax in place, but I can drop the staking tax, the deposit tax, for that 2 weeks as well. So a questicle just for you. I'm gonna make that change. Perfect. I think that's where we should end this update right there. That's bullish. It's helpful. I am always looking for new opportunities to treat you guys well. So if you got anything else, you let me know. Obviously, I'm not going to give stuff away for free, but I'll give a little bit away for free. But ideas like that will make my life easier, make your life easier, make you guys feel like you're taken care of. And I'm all about that. I want to take care of you guys. With that being said, let's give away some stasis. I did do a small OTC earlier in the week. That's where the 250,000 tokens came from, plus a little market buys. So I got some tokens to give away. I'm going to give away $20 in stasis to 3 people. 3 people are getting $20 in stasis. So let me look. This will be just for nostalgia, this is the last monthly update stasis giveaway before we move on. With that being said, $20 in STS. We're going to hit up, a Questicle, you're getting $20 in STS. Thank you for pushing me to make that change. So number one, Questicle, you're going to get $20 in STS. Let's see. Who else? Who else wants some free tokens? I'm going to hit up Mad Hatter. I see you in the audience. I appreciate you stopping by. $20 in STS. I'm going to get Mad Hatter some free tokens. And last but not least, so hard. That's what she said. Let's do Angaro. Angaro, $20 in STS. All right. Equestical, Mad Hatter, Angaro, $20 in STS giveaway. Hit me up in the tickets. Everybody else, thank you so much for joining us for the monthly update. The Q1 March update in a month, right after we migrate. It's going to be a very exciting time. Plenty of data for you guys to absorb. A lot to discuss. I appreciate you for coming. And I hope everybody has a good week, a good weekend, a good month. I will keep you up to date on all things migration, all things client side. It's going to be a good year for BlockCentral. And I appreciate you guys being here. So you have a good rest of your day.